My people, now welcome to today's session. What we go dey look today na deferred tax, and this deferred tax will go show us how we go fit take account for them using in accordance with IAS 12 wey be income taxes. We get one question for here we dey see now, but before I go into the question proper, I go like explain wetin this deferred tax be in a short way so that we can understand am, so I go fit follow for this question and why we get deferred tax. Shebi you know say as a business, if you buy fixed asset na this kind of asset wey you dey buy wey be say you dey use am for more than 1 year. You no buy am to sell am, you buy am to make use of them for your production, for your business. Wetin be the example of this fixed asset? For instance, motor vehicle na motor wey you dey use to transport maybe your goods or your staff, or let's just say your goods from your business to your customer places or to the market. If you no get a motor vehicle, e fit dey difficult for you to operate as you wan take operate. Machineries, plant and machineries na another one. This one na big machines wey you dey also use maybe for production inside your business premises. Let's say you dey produce plastic, they produce leather. They get some kind of sophisticated, some big we call them sophisticated, some big machines where you go dey use to do those kind of production. You go also make use of those things. So as you dey use them, you don't already get plan based on your accounting policy. Say these things you go use them for like 5 years, 10 years, 15 years, 20 years. It depends on how you take go, because the value go dey reduce. You go dey reduce gently till you go reach that number of years where you plan to use them. Otherwise, if you still begin to use them, you go see say money where you go dey spend to repair this particular machine, it go better make you go buy another one. So at that stage, you don't turn scrap and you go fit sell them. Scrap, they get value, and sometimes, but more often they get value. Now there you go come get capital gain or capital loss as a result of what you get. So now, this gradual reduction where they do from the fixed asset where you buy, now they call depreciation. So this depreciation, they give you the allowance for make you as an accountant, make you the deduct them through your profit or loss. Should you know say after you don't get your gross profit, where you deduct your cost of goods sold or services from the money where you just like say you go market, go buy tomato. The money where you use buy tomato, now the cost of the tomato, now be cost of goods. The tomato where you sell, the money you receive when you sell the tomato, now be your revenue. You can't deduct them. So let's say you buy the tomato for 1.5, you sell them for 3,000. So 1.5 will remain, now be your own gain, now be your own gross profit. But you still they incur some expenses. So maybe they pay for rent, they pay for your staff salary. All those one you go see deduct them, so that go tell arrive at profit before tax, where tax authority go come work on. But the tax authority say no, we no dey use depreciation, we will use capital allowance. Capital allowance now for the purpose of fixed asset too, and we'll get how we take the computer and we'll come help you compute them. So now waiting this question they carry us go with that. So now let's start. Now if it don't happen, say capital allowance they apply them, you apply depreciation. Some differences they dey based on what you compute for depreciation, what then they get from capital allowance. So now that difference is now they call taxable temporary difference. So they will carry go the next year, they follow them. But at the end of the day, your total capital allowance and your total depreciation we won't use, they go still zero to the same thing way you they usually say they use them differently. So let's go proper into this question. As we don't spend like 3 or to almost 4 minutes to this introduction. So let's go to the question. They buy one particular fixed asset for 2,000 naira. I'm just using this value so that it could be easy for us at the beginning of the first year of the business. Now they depreciate them using straight line method for the period of 4 years. They say they could use them for 4 years and they won't depreciate them straight line. Straight line means say they would deduct the same kind of reduction every year. So and they decide saying at 500 they would reduce from 2,000 every year. This means that the total cost of 2,000 you go exhaust in that 4 years, because if you deduct 500, another 500, it will turn to 0. Like the plan that. But then additional information they will tax. They say okay, we go use capital allowance. Make we go check where the capital allowance figure dey. If you come to capital allowance here on the capital allowance sheet, you go see say tax authority don't prepare based on their policies and percentage, and based on the kind of equipment where you buy. the kind of fixed asset where you get. If now furniture and fitting, you get your percentage, initial and annual. The one they go first do the first year, and the one they go continue to do in the continuous year up to the year where you go take write down. Then if na motor vehicle, if na motor you get, if na any other thing, they get their own percentage. So then they don't calculate their own already. What they tell arrive at 800, 600, 360, and 240. So now we can go see how we go to apply these things. If you come to under temporary difference, now there be the cocoa, now there the main discussion day. So make I quickly move this thing, come to this other side, so that we go see how maybe we get properly aligned, we get properly arranged. Okay, we don't see them. Now see this first one we dey see for you. This one I first highlight. Now him be the result where you go get if you use your depreciation. This second one we see now him tax authority they use. Then see the difference will come in as a result of these differences. But at the end of the day, your 2000 still finish for the two cases, right? Your 2000 still finish for the two cases. If you plus 12 plus 600 plus 240, and you also have 15, you have 1000, and you have 500 for here. So we go ahead, we see how these things go be applicable, how we go use resolve this issue with the gun. Now, if now depreciation you use the 2000 according to the account, they call them historical cost. They tell say the value you buy, the amount you is buy that equipment, that machine, that fixed asset, you go still the write them down. Now you want to see. We want to see them. Now one method be that. Another method now tax written down value. It means say the net value after I don't reduce the. So make I just give you instance. So every year we want to see 2,000 to 2,000 every year. Now the meaning that 2,000 we go to show see the money for who will take buy this equipment. But you remember say maybe 2,000 this thing remain because you don't already reduce 500 every year. So because you want they still show this to 2,000, you can't say okay too. You go need to do accumulated. You go need to join all the deductions where you don't do from the beginning of the first year. Now why you see say we get 500 for here. The second year we'll get 500 plus 500 will be 1,000. The third year we'll get 500 plus 500 plus 500 will be 1,500. Now the fourth year we can get 500 up to 4 places. We give us 2,000. If you see here, we call and say na nil. It means say na 0. After the fourth year, the thing don't be 0. So if you see say 2,000 minus 500 will give 1,500. 2,000 minus 1,000. So each of the year 500 they reduce. So it means say at this year it reduced to 1,500. At this year it reduced to 1,000. At this year it reduced to 500, and that's so you take clear from the other year. Now this let's now go to more see how the tax people take talk their own. So their own they talk say 800 they will use, 600 they will use, 360 and 240 based on what we already see for capital allowance sheet. Now another method be this again we will use say okay I don't want to show my 2,000 every year. I want to show the actual value where they remain after I don't reduce this capital allowance. In our own case now depreciation. Now you say now why would we get 2,000 minus 800, 12 minus 600. The balance 600 minus 360. The balance 240 minus 240. I didn't want to use 2,000 for here. What we will do be say the right thing to do be say we'll get 800 for here. We'll get 800 plus 600. It will be 14. We can get 800 plus 600 plus 360. We will be 14 plus 360. We will be 1760. The 1760 plus 240 will be 2,000. At all, now the same thing. Two of them they talk about in respect to how the value of it will be reduced from them. Okay, now see the difference at the end of the day. 1,500 for here, we'll get 12 for here, we'll get 300. 1,000 for here, we'll get 600 for here. With the difference now 400. 500 for here, we'll get 240 for here. Difference now 260. Now, what will be the essence of this difference? We want to calculate to start with. Now, because government done our accounting principle and the law we don't stay ground. Don't see we feel reduce those we feel reduce this amount of expenses to take use get it before profit before tax. Profit before tax it means say the value will remain where government will come tax. Make I give one very good example for instance. So let's say as we do it like this now, we generate revenue, we sell our kaya, we can't get like 15,000. Now the money wey we take use buy the kaya and any other small chunkuli thing wey we take incur because of say we wan go buy that kaya, let's say na 7,000. So at the end of the day, we dey get balance of 800, so 8,000. So make I just do one small thing like equal to, we come select this one, come say minus 7,000, we come get 8,000. This 8,000 na wetin dey call gross gross profit. Then this 7,000 na wetin dey call cost of goods sold. Na the cost of wetin you buy wey you sell. Then this one na the revenue, the money wey you don generate after you sell those things wey you buy. So this gross profit, e no tanda on e own finish. They talk say okay, to you get some small things wey you dey do, like you dey pay salary for the staff wey dey work for you. Abi the shop wey you dey use, you come dey pay rent for am. Light, you dey pay for light and water. So all these things, utilities, na so they call am, they say na utilities. So let's say e come happen say here come be 500, here come be 600, here come be 800. So at the end of the day, wetin they talk say, they go say you must reduce this value from here. So you come be equal to, I just want to do am small so I go understand, minus this one minus this one minus this one. So it means say at the end of the day, na 6,100 na they will come charge you on top. Wetin come be the charges? More come talk say okay to their tax, so wetin they talk say, they say na 30% they will charge you on top wetin remain. So if you come do 30% of wetin remain, wetin will be, let's say equal to 30%. So come say 30%, come say times 61. So what did you see? So your profit now, where you go? Make I quickly name them for here. Okay, maybe make I just drag this one come this side so that it will be proper for us. So I'll just drag this one come this side. There. I can't call them profit before, that is after tax. No, now the tax be this safe. Now the tax be this. Now the tax value be this. We don't already calculate them. So tax value. So you see our tax value now this one particularly now be profit before tax. Abi, and our tax value they say na 30%. So we don't put 30%. So over down here, we can't go to they call profit after, they call them parts after tax like this. So now the value will go remain now going to be equal to 61 minus this 1830. So it means say see wetin you go carry go as go chop, go use and buy biscuit, bread, buy food when I go take chop for house. Abi now let's say one of these things wey dey na expensive, na depreciation. This depreciation we will talk about, we'll just calculate for up here. Say na be depreciation because of say you get fixed asset wey they make, and now 500 now you dey deduct. So it means say the value you get now 4,340. Now tax authority come to say no, we don't go use this 500 though. This 500 we they use, we no want time. What we want use now our for the, and remember saying at the first year now they calculate for, we won't use 800. So if you happen to say now 800 they won't use, we'll come here, come put and say 800 for here. So let's say depreciation now 800. We can't put, they go remove this, they go add this money back. Make I just do one small illustration. What the tax authority go do, they come here, they come say to, oh yeah, we will go add our that money 500 we deduct to go add them back, so plus 500. Now, but we go remove only 800. Which will be the capital allowance, so we don't calculate. So we now 800 we want to remove, not be 500. We can't sum them up. What did they see for here now? Will they get? Make us see that I know select the okay, this one a profit after tax. Now this one I'm supposed to do. So it's supposed to be D2020. I think this one. It's supposed to be our profit before tax. Maybe the other one I suppose use. So when they come to say no, we won't add back the 500 where you deduct that time. You go see say if we add them back, it will be 67. So we now what we can calculate now on, we remove only 800 based on what we don't agree say now be the capital allowance for the first year. Now we don't remove 800 from here. So we assume say this 67 now be this our 62. This 59 will be the after they don't add them now. Now we use replace this 62. We don't use and replace this 62. So this 59 now be this 62. This 67 now be the figure we'll get after we add the 500 back. Say no, add and back. We will reduce 800 instead of 500. Now why you can't get what they call 5.9? If you look 5.9 for you, now what we can't charge you on top. We can't say okay, we won't charge 30%. Then I'm gonna do one small thing for you. We can't do equal to 30% times this one now we remain. What will be the figure now? 1770. So it means say now what in the one tax will be this 1770 we see for you, it is lesser than the 1860 where you suppose where they supposed charge you. So it means say this one benefit you. Make we won't finish and make we see how you think will show. Can't say equal to make this enough for confuse us. Make a carry this thing come down so that we'll see how it will follow. I think say now something like this. So profit before tax now be this 67. Then our tax we don't charge now be 5.9. Just in a 5.9 more check on. Okay, no be tax. So now this is supposed to be. Suppose carry this one come down like this. Yes, now this is supposed to be. So our profit before tax here now 5.9. But profit before tax for here now be 6.2. Abi, she said this one day higher. But the main thing are the tax. So tax for here now 1770, but tax for here now 1860. She said this one day higher than this one. So this one it go better for you small. This one benefit you small because what will happen? We could see our profit after the tax. So we carry go as go buy that bread and biscuits, bread and beans. So go to use chop. They go is the alright. So we can say okay, profit before tax minus the tax minus 1770. What do you see we get? We get 4,130. 4,130. So now it means say 4130 where they carry go out, it is somehow lesser than the. So as a result of say the value where they reduce now, this profit before tax now don't they smaller than the 6 to here. So every other thing will be smaller in a way. So now 4,130. So but may I know if you get confused of this one, no worry. We'll also show you for the other of the templates, the other sheet we explain them very well. So now based on what we don't get for here and what we don't get for here, we don't already calculate the difference, right? So if you can't come check here, we can't do the 30%. This is the tax rate now. We can't say 30%. Make I quickly do like this so that I think will expand. Okay, maybe that amount time. And just drag on small. Just drag on small so I go show. Okay. So see for each of the difference, I do 30%. 30% of 300, 9 give us 90. 30% of 400, 9 give us 120. 30% of 260, 9 give us 78. So now we can go see how we go to make use of this figure. We go to show for our profit and loss and our balance sheet. Now you will carry us go the accounting entry. Now for the first year, we will take get difference of 300. We will get 30, 90. If you see our accounting entry, they say for the first year we go do 18. We go debit our income tax expense. We go to show for our profit and loss. You know, say for accounting they get what they call double entry principle. Where they talk say if you debit one at the minimum, say at all, if you debit one account, you go credit the second account. If it possible, say if you debit one account, credit two account or three account, or if you debit 2 or 3 account, credit 1 or 2 account, if possible. But in this case, now just one side and one side. So we'll debit income. This one I'm going to show for a profit and loss account. Then we're going to credit deferred tax liability. We're going to show for balance sheet. Now they call statement of financial position as 90. So you're going to show say this 90 day for grant for us because of say the thing we supposed charge for here. Now what do they call them? We supposed charge on top 1.5, but we can go charge on top 1.2. But let's use this one I don't already put for you now. You see say now 43.40. So we could just do one small difference. Say equal to this one minus this one. Can enter. You see say the difference now 210. So now that 210 now go they carry the follow you up. Say okay, normal. Now 43.40 you supposed pay. I mean now maybe 1860. Now can go that 1860. No verse. Okay, 1860 minus 1770. Now that's supposed put am will be 90. So normal na 90 I supposed pay. But additional 90, I mean to say, you supposed pay 1860, but you can't pay 1770. So less of 90. For the fact say you no pay that 1860, let me say we no go follow you up for that matter. You go pay am. So just go put am for your balance sheet. Make we dey watch am. So the next time we go come, we go carry them and put am say, oh yeah, this one go follow. Wetin we go charge you in the next. It depends on how it reduce, whether it reduce or it increase. If it possible, say here fee reduce pass wetin tax authority say they won't pay. But for this case now, it is higher than wetin tax authority won't pay. They want more pay. So if here they lesser than wetin tax authority want more pay, the reverse will be the case for the posting. Now, this one go show for profit and our balance sheet. This one go show for profit and loss. Now be the first year. For the second year, we can't get difference of 120. Make we check. See here 120. So it means say the thing don't increase. Increase. Why? How it increase? If you look at this 500, you remember I said that 500 would reduce every year. 500 a year, 600 a year. So it increased by 100 from here. 500 a year, 800 a year, now 300. So, but if you come to this third one, we'll come to this third one, we will see. So the second one is still the same thing with the first one. So, but now the difference is what they look for. So, what will differentiate 120 from 90? What will be the difference? Now it be 30. So now that 30 will carry go meet that 90 for where it did for profit and loss. We'll come go carry and go meet balance sheet for where it did. Now why you see say the same thing, these two things look like the same. So but what the difference now be the value. So if you add 30 plus 90, it will give you 120 for profit and loss. If you get 90 plus 30, it will give you 120 also. So now why we get 120 for here. The next year, what will come up for the third year? 500 is still there here. We're not saying that 500 deduct every year for depreciation, but here now 360. It don't turn, the table don't turn around because here now our depreciation what they use it is higher than the one way the 360 with the charges. So it means say here now don't they lesser than this place. This tax will pay for here could they lesser than this place. So imagine say here now 1770 and here can be 1860. What this thing mean now be say we supposed pay 1170 as our tax, but because of capital allowance wahala, they can't carry their wahala come with us. We can't go pay extra. This extra will come pay for here. It will reduce. We suppose reduce our burden for us next year. Now why the posting can't come reverse? Come to say oh yeah, we go debit our deferred tax liability account. If you post to the debit to the credit side, now increase it they do. See and say here now increase will column, here now increase will column, and a liability where they here credit now increase, abi credit now increase and a liability. But now we can't put debit. So for debit can't post for now. It means say it thing go reduce within day. Putting the reduce on to make we check the difference now for the third year now 78. Remember I said we get 120 before. Difference between 120 and 78 now 42. So let's try and see. So equal to 120 minus 78. What we get? We get 42. So now for now 42 the thing supposed to show. It's supposed to reduce because of the extra burden, just like I explained earlier on. Now why we did debit the deferred tax liability to reduce within the inside to 78. Remember I said now 120 the inside, so 42 come up from 120 will give us 78. The same thing will happen to the income tax where they show. We will credit them, now decrease if they do. So 120 did there before, we will reduce them to 78. Now for the fourth year, now 0, nothing happened because of say it don't be 240, 500, 500. Now why we say okay, nothing remain again. So the total balance will be 78 will remain. We could still do the same thing. We could debit to reduce the tax liability. So I'm not going to show again for our balance sheet say anything they grant we don't go tax next year. The same thing with our profit and loss we they show decrease by 78. So everything from the beginning here to this place, it start from 90, enter 120, enter 78, come turn to 0. Now see the template for here if you want also use the template. Now this one now for trial balance, you go see and trial balance now we'll pick up from there, say okay, see the opening tax liability for the next year. Then based on the say a increase or a decrease, now we will know whether we will add them or we'll reduce them. So you shall see that before we get 90, we can't get 30 as difference, can't get 120. Now what we do before. Now we can go the main cocoa where everything they interesting. So just like what I illustrate for us for here, we look like say I want to scatter some people head, including my own. Make we see how easily you go there for here. Now say the profit before tax now 10,000 for year 1, year 2, year 3, year 4, all things being equal. We just want to try make am easy. Come to say okay, see waiting they reduce 500. So we don't add them back. So now the profit before tax be this, just like I do for here. I go meet profit before tax. Now I have to use work for here. You see that one day. We'll continue. Now they go add back the 500. So 10,000 plus 500, 9 they do. All of them on 15,000. They say no, that 500 we do no one time. We will get our own. We will use our own. Maybe 800, 600, 360, 240. So if you add 10,000 plus 500, that is 10,500. 10,500 minus 800 for you will give you 97 minus 99. We could check whether we tell the talk. It has to be. So for here now, summation formula I use. I just use make it see how it be. So this plus this. But since now negative there, so I no go do minus. Now negative 800 there already. So I just put minus 800. Make a type on with my hand. So I go see it will still give you that 97. Now 9799 10,000 and then 10,260. This is taxable profits. What we want tax. Now this one we want tax. Then we consider 30% of all these ones. Now give us 2910 up to when you can give us 3,078 naira for year 4. Now based on the increase and the decrease, what we'll do. Remember that first one at 90. Same for here. We'll get 90, we'll get 30, but here now decrease 42 and here now decrease 78. But here now plus based on how this our 500 we did for here, they above, they below 800, 500 here they below 600, but here 500 now they above 360, 500 here they above 240. If you get any question, don't forget to drop them on the comment section so I will attend to them based on what we just see for here. And if you get another one we want more to cover, they happy to help you with them. So now see the 90 and 30. So we'll add them together with this 290. This is a total tax expenses now 3,000 throughout. You add this other 30 to this 270, it still give us 3,000. You minus this one, it still give us 3,000. You minus this 78, it still give us 3,000. So this is the way we say you go to use the compute your deferred tax because of those taxable temporary differences with the occur based on say you use depreciation, tax office say them they won't use capital allowance. So this one don't carry us come the end of this class. I bet if you like this video, give us a thumbs up. And if you get any further question we want to treat, more handle as it is hot, don't forget to drop them for the comment section. We will be very happy to touch and share them to your friends. Tell them say, oh yeah, see our one of our brother down there, they help us, they show us waiting and how we they prepare our account moko for the tax compliant and moko for no get fear for waiting those tax people they do with our account.